We're answering your money questions this morning with financial expert Terry Savage. Terry, thanks for being with us.
Well, good to be with you. It's a day where right now the stock market is about unchanged, holding its breath to see indeed what the Fed does. It's likely the futures markets are pricing in a quarter-point increase, so that's what's most likely to happen. But for most of you out there, the real question is, how safe do I feel with my money in the bank? And I'm giving you the savage truth. You should have always felt safe because you were insured up to $250,000. The collapse of Silicon Valley Bank and Signature Bank made it clear that the Fed, the FDIC, and the Treasury were going to do everything possible to make sure that the banking system did not suffer a panic run. And even though I've heard from lots of people posting at terrysavage.com, is it safe? Should I move it? Right now, although there's no congressional rule that says the deposit insurance will be higher or cover everyone, you can be very sure that they will step in. So I think this is a time to just calm down a little bit. I want to say one other thing. Always before, when we had bank failures, I mentioned this last week, the problem was the banks made bad loans, the mortgages and so forth, go the savings and loans back in the 80s. In this case, they took the depositors' money, put it in perfectly safe U.S. government bonds, 7, 10-year bonds, and said, that's fine. Well, that'll be safe. And the depositors have their money. But if the depositors, they didn't have to put the value of the bonds down as interest rates went up. The Fed increasing interest rates meant, hey, your $1,000 bond on the open market that has a 2% yield isn't worth $1,000, it's worth $600, because if someone had $1,000 cash, they could buy a 4% bond. But they said, that's all right, we're never selling those bonds. We're waiting until they mature. They're good. Until the depositors wanted their money out at that big Silicon Valley Bank. So this is not a crisis of credit in the banking system. This was kind of a crisis of confidence and being marked to the market price of those government bonds.
All right, let's get some viewer questions. Is this a good time to convert to cash in my 401k in the event the debt ceiling is not raised timely?
Okay, so that's the next thing coming down the pike. The Fed will probably be balancing its need not to cause more interest rate problems with its need to fight inflation. But then coming down the pike is Congress and this whole idea of not raising the debt ceiling. First of all, they will raise the debt ceiling. They will, despite their political and extreme differences, they will raise it. Second of all, in your 401k, there's probably not a money market account. There may be a stable value account. And what you do inside your 401k depends on where you are. If you're in your 30s, 40s, early 50s, you've got 15, 20 years at least till retirement. Think about it. The Dow is well over 32,000 now. If you had pulled out into a money market fund way back in 9/11, after 9/11, that was so scary and the market went down. In 2008, that was so scary. You would have made a big mistake. You would have missed out on all the growth. The market's doubled since then. So think long-term in your 401k. If you're about to retire and you need some cash for required withdrawals or to live on, then you go to the more conservative choices.
All right. A question we seem to get frequently, where should I go to get my credit score?
Well, these days, most of your credit scores are probably you can get on your bank statement or your website of your bank. But my favorite place is creditkarma.com. They don't bother me too much with offers of lower rate credit cards and stuff. And they have a nice graphic, and they do send out a reminder whenever your credit score changes by 3 points or so, but mostly because that's the day after you paid your bill. So creditkarma.com.
All right. This person says, I'm the executor of my dad's estate. His home sold at the end of February. He has $38,000 in credit card debt. Do I owe that money?
Well, that's an interesting question. No, not legally. Credit card debt is called unsecured debt. A mortgage debt is secured, and if your father died with a mortgage on his house before you could sell it, the bank would have to be repaid. But the credit card debt is unsecured, so once the estate is closed, they can't come after the estate. Whatever money is left is distributed. And I think what you want to do is send each of the card issuers a debt certificate and say just deceased, unable to pay. And very few banks will go after you or go after the estate unless it was a significant amount of money and they thought the family was wealthy. Maybe.
All right. Well, if you have a question for Terry, you can go to terrysavage.com. Thanks for joining us.
You.
Time now for On Town.
Hey, Anna.
Our show.